Welcome, ladies and gentlemen. I'd like to welcome you very cordially to the press conference of LOTOS SA. We will have the great pleasure to present our financial results coming from the effects of our work in the group in H1 2017 as well as for Q2 2017. I would like to very warmly welcome all of the people who are joining us by internet. You have the opportunity for the first time to track events and pose your questions actively through the internet chat. The people who are going to run today's presentation are members of the management board. So we have the person who's responsible for production, Mr. Szoza. We also have Mr. Majewski, who's the CFO of the company, and we also have Mr. Mateusz Bonsa, who's the vice president responsible for strategy. My name is Paweł Bojnowski, and I'll have the pleasure of moderating today's meeting. So let's begin by doing a quick recap. These are the key facts and events that transpired during the most recent quarter. Welcome, ladies and gentlemen. I'm very pleased to welcome you here. I'm pleased to welcome all of the people joining us by internet, people who are watching us online. It's a great pleasure for me to be able to open this presentation, to kick it off and say a few words about the key results of the group in this period, as well as about the upstream segment, and then I'll give the floor to my colleague who will say a little bit about production and sales, and then I'll give the floor to our CFO who will basically sum up our consolidated financials. Q2, and in fact the entire first half of the year was a very good period for us. We completed our renovation in Q2. We were able to do this successfully, both in terms of the budget, the timing, as well as technologically. We believe that sales will continue to grow on the domestic market, also as a result of legislative measures, but also as a result of our sales efforts. We have confirmed our ability to pay a dividend. We're going to pay a dividend of 1 zlotys per share. This was confirmed by the shareholder meeting. And so our debt ratios are following. It's a little bit below our strategic objective. We're going to have some investment objectives in the future, but we're very pleased to see that we're in the safe regions. We're diversifying our sources of oil supply. So 28% is something different from oil from the Urals. And we're very pleased that our stations at LOTOS are becoming more and more well recognized in terms of the quality of service they offer, their cleanliness, as well as the quality of fuel. And so we're very pleased to see that we enjoy such brand recognition on the market. Let me say a few words about the macroeconomic environment where we operate. This is the next page of our presentation. Of course, when you look at a company like ours, you have to have in mind what's happening on the market. And if you look at our strategic targets, this was the strategy we announced in December of last year. And then looking at what's happening on the market, we're not far from our strategic targets. This is something that is a source of pleasure to us because that means that the company is working efficiently in the conditions that we had anticipated would take place. So if we look at the prices of the key commodities, so looking at natural gas and Brent, they're not much different from what we had assumed. Of course, the prices are a little bit higher than we had targeted, but these are not major differences compared to what we had anticipated. If we look at products, cracks, so we see that the price is a little bit lower. And, well, we can say that diesel heavy oil. They're a little bit higher than what we had anticipated. This has not impacted our strategic assumptions, but we can see that the planning was done sagaciously. Now, if we can go on to some of the key numbers, let me start with Q2, and then we'll talk about the full half year. So our EBITDA, according to LIFO, so we had a 20% increase, 27% increase compared to last year. This is a wonderful result in both of our segments, and we can see that our results are improving. If we look at debt, I've already mentioned what's happening with debt, but we see a downward trend, and this is stabilized. And of course, we'll naturally use financing, but we feel that we're at a safe level. We have a safe position if we look at production and the refining of oil. We're maybe a little lower than comparable quarters, the comparable quarter of 2016, but we should have in mind that we were still in the process of doing a renovation, which was planned downtime. And if we look at the daily production of our hydrocarbons, there's a little bit of delay. We're a little bit below. And looking at our licensing resources, well, we're going to talk about more of that a little in greater depth in just a few moments when we get to upstream. So if you look at the first half of the year, you can see that again, we have a very good result. We're up 26% in terms of our EBITDA according to LIFO. Last in, first out. We look at our cash flow and operating activities. We've got very healthy cash flow, which makes it possible to run our business comfortably on a day-to-day basis. If we look at production and sales, oil refining, a little bit lower than in 2016, but again, this is linked to the renovation that was completed successfully, and we're now on very good production levels. And if we look at our mining efforts, in the total figures, we see that we're down from H1 2016, but we still have very high numbers. We've got some 25,000 barrels per day, or nearly 26,000 barrels per day. And this is aligned to our strategic targets we announced in December of last year. So LOTOS at present is a good, healthy company with a healthy foundation. We're generating healthy cash flow, and we're operating according to the plan that was put in place more than half a year ago. So a few words about our upstream efforts. The mining segment. This is slide number 9. We've got information here about reorganizing the mining segment in order to manage it effectively. We've made the decision that we would like to create a specialized holding company that will be able to manage our assets we have distributed across several countries. At the same time, the management structure would enable us to manage the risks according to the various licensing areas, profiles we have at geographies and jurisdictions. So we'll be able to manage things better, but at the same time, it'll be easier to make decisions within, let's say, looking at the arbitration across the markets where we are present. So a few words about our production assets we currently operate. We've got 2 fields in Poland, B3 and B8. We have 2 other hubs. So we have Sleipner Handel in Norway and Allegro Nafte in Lithuania, and we see effective production in all of these areas within the last 6 months, with some natural decline as a result of the depletion of the deposits, but we have development plans. And so B8, B6 in Poland, in Norway, we have a series of new licenses. We've already talked about Gderfet and Yemen, and we also have this one we're still working on, and then Geonafta, AB Geonafta, is a natural area where we can operate effectively and efficiently, but it's not just a significant business yet. And so you can see the costs of mining: $27 per barrel in Poland, 7 in Norway, 11 in Lithuania. So these are good parameters if you look at the current market conditions, both in terms of the economics and the market quotations, prices, and so the business is sound and healthy. So a short sum up of our results, operating results in this segment in the first half of this year compared to 2016. So if you look at our adjusted EBITDA, we're up some 37%. We're operating efficiently. Of course, prices have helped, acted as a boost, but we've done some solid work on all of our concessions, and we were working together with foreign operators, like in Norway. We're working with the best, the safest, and we're working with partners as the resources are depleted in order to generate such results. So it's a positive picture for the upstream operations. And so over time, we'll be able to report more successes of our team and our concessions. And I'll give the floor to Mr. Kabula, who will say a few more words about our production and sales efforts. Good afternoon, ladies and gentlemen. In production and sales, so in our downstream segment, Q2 and H1 2017, were according to plan. The most important thing was to complete the renovation and to start up the refinery after this renovation. And so we had some downtime for this renovation. We completed this on schedule, precisely on schedule. On the same day, we assumed that we would launch production. We launched production. So we've completed all of the work we planned to do. What else is important here? And you can see in the commentary to the results, we were able to do this under the cost budget, within the cost budget. And so for H1 of this year, we had refining operations on some 2 million tons. That's Q2. But from the time when the installations are available for refining operations, we're refining, utilizing the full capacity we have. That's important information. The renovation was able to remove some of the bottlenecks. We've invested some money to streamline our operations, to make them better. And so they're better than what we had prior to the renovations. We continue to diversify our sources of oil. This has given us a result of 26% in the supply mix, different from the oil from the Urals. And so if we look at the environment, we've seen this in part. If we look at the value of the product cracks, and so the cracking products, and so we have everything brought together in one single refining margin. And so in H1 2017, we had a slightly better set of market conditions than in 2016. So the model margins for refining operations gave us a robust basis to generate results in 2017. So if we go on to the next slide, and you can see information about our key investment project in the downstream segment. So this is the EFRA project, and so this is on schedule. This project is running on schedule. We can already say that we've done some of the final acceptance stages. Some of the auxiliary systems, ancillary systems have been completed, have been accepted, and we can be pleased that the work progress is on target in terms of the timing, and this is giving us a very good basis to anticipate that the overall project will be delivered effectively. Let's go on to the next slide. So a few words about the retail segment. This is about our fuel stations. And so if you look at the retail segment, it was already mentioned that the assessment of our quality given by the consumers in terms of how we're perceived at our stations in terms of the quality of service, the quality of fuel, cleanliness, we are the leader in this segment based on consumer assessments. We're developing on the market with a good outlook. We're talking about fuel stations along the motorways. So we're on the expressways as well as the motorways, and we're developing our concessions. We're investing in this segment. And in our point of view, this will be a segment that will continue to grow. One other piece of information. We have an agreement with Shell in terms of respecting our business cards at Shell Poland fuel stations. This is a result of a bilateral agreement on LOTOS stations for nearly a year. Shell fuel purchase cards are respected at our fuel stations, and now our customers who hold the business cards can utilize the Shell stations. This is it in terms of what we wanted to say about the downstream segment. But I'll ask my colleague, Mr. Majewski, the CFO, to say a few words about the finances. So I'd like to welcome you, ladies and gentlemen. So if we can go on to that part of the presentation in terms of the results of production and sales. You remember that they had a big burden in the form of the renovation project and refurbishment project. But we had also two one-offs, not visible here. Less than 108 million was spent directly for the refurbishment, but we also had less access to our production installations for a month, and we were able to generate higher cash flow, or that segment was able to generate more cash flow than in the corresponding period of the previous year. And so if we look at the adjusted results for 6 months, we've been able to exceed 900 million, so it's 20% higher than last year. And so if we can go on to the consolidated financial results, having in mind both segments. In Q2 of 2017, the adjusted EBITDA, utilizing the LIFO methodology, is higher. We have more or less 27% growth rate here, even higher than in production and sales. And we were able to achieve this result despite the fact that we had downtime for production operations at the turn of Q2 and Q3. So we can say that Q2 was heavily under the influence of this event. But if we compare quarter to quarter, from year to year, this quarter was much better in Q2 2017. If we can go on to the next slide, we recap the overall 6 months, first 6 months of the year, and we can see that the company's results compared to last year are more favorable. We've got a 25% growth rate in our adjusted EBITDA according to LIFO. So it's a little under 570 million. And so it was 330 last year. And so we have in mind all of the other factors that I discussed a moment ago. So ladies and gentlemen, how has this affected our liquidity? If we look at the operating cash flow in Q2 2017, it has climbed substantially compared to Q1, but we had some changes in worker capital as a result of the downtime. I think it would be more appropriate to analyze the interim data, so for the full half year, so we can see that the operating cash flow was around 880 million zlotys less than last year when we had 950 million. But if we remember about the direct costs of the renovation refurbishment or the overall overhaul, we had much higher costs as a result. We've also invested more. We had a very high capex for installations onto the EFRA project, EFRA. We spent more than around 500 million for just that project, EFRA. So we had very high capex in the full half year, so it was almost 800 million. Despite that, we continued to earn more on our operating activity than we spent on capex, on investing activity. And so this has had an impact on our debt ratios. The next slide portrays our debt ratios. So net debt has come down to 4.1 billion. So from the end of 2016, this is a decline of roughly 700 million. In part, this was caused by the Polish zloty becoming stronger against the dollar. We have a fair amount of dollar-denominated debt. But if we look at the debt ratios, debt multiples, this has contributed to major improvement. As Mr. Bonsa said, we're at very satisfactory levels and very safe levels. We're at 44% at 30 June 2017. And net debt to EBITDA, according to last in first out methodology, is down to 1.4 times from 1.9 times. And so these are levels that are lower than we had posited in our strategy. But the first half of the year was better than anticipated, and we've generated very robust results. And so we can say that the Polish zloty has strengthened against the dollar faster than we had assumed. And in our strategic assumptions, we had assumed that the zloty would strengthen, but at a much slower pace against the US dollar. Even so, we're pleased that we've reached such a level, and this gives us a very attractive base to achieve our subsequent intentions. We have a good amount of capex in H2 of this year planned, so the end of the EFRA project. Then we have some other smaller scale projects in our upstream, as well as production and sales efforts. And so this gives us a lot of comfort in terms of our running our investment program. So thank you very much for your attention, ladies and gentlemen. Ladies and gentlemen, this slide brings our presentation to an end, and we'd like to invite you to pose any questions you may have. We'll happily try to field them. So we would ask the people who are here in the room to pose their questions first, and then I'll read out the questions from people who are watching us in the internet. Welcome. My name is Bartłomiej Majer. I'm from Puls Biznesu. My questions are as follows. First, what are the anticipated capital expenditures for H2 of this year? And what will the impact of this capex be on your debt level, measured by net debt to EBITDA in H2 of this year and at the end of the year? What are your anticipations, expectations concerning debt in 2018? And a question about your retail business. You've stated that you have 485 stations operating under the LOTOS Group label. Could you give us some more drill down highlights? I'm talking here about the economic segment, LOTOS Optima. How is that developing? What are your plans? to continue expanding those type of fuel stations, petrol stations. I'll try to respond to the first question, and Mr. Bonsa will respond to the second question. So CapEx for 2017 is roughly 2 billion zlotys, which means that we'll spend a little bit more than 1 billion in the second half of the year, but we don't anticipate that this will have a big impact on our debt ratios, assuming that the FX rate between the dollar and the zloty is going to be more or less at the same level as present. So the impact, in other words, we're going to spend more or less, well, as much as we earn. We have to pay out the dividend in the second half of the year. Well, so these two factors should not affect the debt ratios, the debt multiples. The only thing that could really make a big impact would be a major swing in the US dollar PLN exchange rate, but I don't think that's very likely. The second question about our petrol station network, and in particular the Optimia, the economical station. At 30 June 2017, we had 204 such stations, and we're scrutinizing them very closely because this subsegment of the market requires special attention. As you are certainly following the press releases of the company, we're developing this segment. We're offering a broader array of products where it's technically possible. We have a premium fuel. We're expanding the loyalty program at these stations. We're trying to utilize the potential for them to be able to be more economically viable. Where it's technically possible, we endeavor to expand their product and service offering, and we're trying to augment the quality of service by working closely with our partners who run these stations, altering to some extent the standards of quality and enabling them to utilize the positive elements that flow from our loyalty program. As you've noted, we're developing these stations by placing great emphasis on the petrol stations along the motorways where there's a large amount of volume. We're not resigning from the other stations. We see more great potential in universal stations that offer a broader array of products where we can generate margins not only on fuels, more effectively, so we want to have more products that have thicker margins. I'm from the Business Alert portal. My question is slightly different in terms of the northern direction. I understand that the open season procedure is underway in Norway, Baltics, and the question is whether or not LOTOS, having in mind the concession you hold and what you've said previously that you're interested in developing your base of concessions. If you look at the Baltic pipe, is this of interest to take your reservation there? Are you working on that direction? Of course, for LOTOS, every additional logistical opportunity to expand sales of our products. So if we look at the extraction of gas is going to be a major strength, and we're watching closely what's happening with Baltic Pipe. And if that possibility exists, we'll certainly want to take advantage of what that pipeline would give us. Some to sell the gas we're extracting in Norway. This production will fall in upcoming years. It will depend on what extent of investments we'll pursue in this region and whether or not we should increase the production of gas there or stay at the same levels. And it's also dependent on certain commercial assumptions, which we're not familiar with at this time, but we're all certainly interested in those opportunities. I have two questions. My first question is about the debt, and since your EFRA project is gradually drawing to a conclusion, should we anticipate that you'll pay a higher dividend in upcoming years than the one you paid or intend to pay this year? What is your approach to the dividend policy? The second thing is about the supply split where you're sourcing oil. So you've stated here how much oil you're buying, not from the Urals. Is that something that you can continue to diversify? If so, from which geographic directions can you source more oil? So if we look at the debt level, as you recall from our strategic presentation, we assume that we should have a relatively stable level of debt, which is net debt to EBITDA around 1.5 times, and we've come quite close to that level. And this, of course, can open up the opportunity to pay higher dividends in the future. But as you certainly know, we've not presented thus far any sort of guidance in terms of what one might consider. The company has just emerged from debt levels that were considered to be slightly excessive, and we're doing some investments. And so if we look at the amount of dividends, we're going to talk about this, I think, in subsequent years. Right now, that discussion would be slightly premature. In terms of your other question about oil delivered to Gdańsk, our current results, which we've generated over recent periods, we've been refining oil from a variety of geographic directions. It's not the case that we only have one single direction. Every purchasing decision is preceded by a specific calculation on the viability of such a transaction. So all of the deliveries of oil to Gdańsk are deliveries we earn money on. Right now, we're sourcing from the North Sea as well as from the Middle East. We assume that these directions will continue to work for us. And recently, a press release was released on a new direction, and this would be from a new source from the US. So we're working on selecting commodity or a blend of commodities that could be delivered to Gdańsk from the US. And this is one bit of the outlook for the future. So we assume that we'll continue to source product from the same sources, but we're looking for new sources of supply as well. I'm from Energetyka 24. I wanted to ask you whether or not under your oil diversification policy, in order to optimize deliveries, Are you thinking about making joint supply decisions with Orlen to Poland? We have to remember about one very important thing. First, we compete with one another. Second, we have our own optimization accounts, and something that's profitable for us doesn't have to be profitable for PKN Orlen, and the opposite is also true. So we don't have any sort of talks about joint procurement of oil with that entity. So we'd encourage you to pose your final questions to people here in the room. If you have any more questions, please go ahead. I wanted to ask a follow-up question about your operations in Lithuania. You've mentioned the operation of the company in Lithuania. I understand that it continues to have a positive outlook. Is that truly the case? Because the oil supplies are gradually being depleted. What really is the outlook for your operation in the land of our neighbors to the east? Lithuania, if we look at the numbers, is a smaller contributor to our upstream operations. Economic viability covers there. It's a small deposit, and we're able to extract that oil economically viably as long as that's justified and it's working there well locally. We don't see any reasons whatsoever to withdraw from that market. It's a good place in order to complete our upstream mix, so our production mix. That's why we're staying there. I have another question about your upstream segment, mining segment. Why do you have a decline in Q2? And since the reserves and the deposits are being reduced, are you planning to make any investments in this area? Thank you very much for the question. What we have observed, a slight decline in production, so mining output in our licensed areas, is a result of the natural structure of this business, the natural depletion that occurs. Our strategic assumption is that in 2017, 2018, based on the deposits we have in our portfolio, this decline will transpire. However, at the same time, we're actively working on acquiring concessions, the ones that we have, to enable us to expand that portfolio. We have the B8 project to make it possible to extract oil with the infrastructure we have viably. We also have a series of projects, licenses in Norway, which in a natural way in subsequent years, in line with our strategy and our plan, will enable us to replace that extraction activity. So Mr. Jastrzębski talks about this frequently. We're actively looking for acquisition targets. So if we see on the market an ability to invest in a deposit or in deposits that have positive return profiles and have good economics and production dynamics, then we look at those projects quite closely, and we don't preclude those type of investments And so we have posited a rather high capex for the years 2017, 2022, which is 9.5 billion zlotys almost, of which 6.5 billion was allocated to a variety of projects. 3 billion, I mean, is for upstream projects. And so there is a delta there of 3 billion in capex that we're going to make decisions about whether or not we're going to move in the direction of production or retail or upstream. So we can't preclude the fact that we want to make our portfolio even more effective, have a better return profile by investing that money there. Thank you very much for all of your questions. So we'll invite you to communicate with us by email in terms of the questions you've not posed. So we're interested in responding to your questions that are easy, difficult. If we look at the web channel, amongst the many questions, I've been able to pull out one, and the question is false. If you look at Heimdall, is the downtime for production, is it going to have a big impact on Q3 results of this year? One of the internet users posed those questions, and so he's probably waiting for a response. So if it's possible, I'd ask for a question looking at the Heimdall project. I'm going to have to leave this question a little bit without a response. It's an interesting question. We don't think it's going to have an impact. We're focusing on past results. We look at Heimdall on the other location. They've given us positive surprises, and we anticipate that they're going to continue surprising us in a positive sense. And I think it's worthwhile to talk about this in, say, 3 months from today, and we'll see how those things are operating. But up until now, we've been positively surprised by how those deposits have performed and how well the operators have performed. So I think that's something quite natural. Thank you very much on behalf of the internet user who posed this question. Okay, ladies and gentlemen, we'd like to thank you very much for your attention, for your attendance. We'd like to thank you for your questions. Thank you very much.